Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1273A and today's date is May 7th, 2017, and the title of the episode is Central Banks Injected Trillions into the Market to Prop It Up, and It's Not Enough. Now, before I get started, I just want to make an announcement. Yesterday I uploaded an interview with Michael Pinto. It is on the X22 Report Spotlight YouTube channel, so all you need to do is go over to YouTube, type in X22 Report Spotlight. It will bring you right to the video. Or you can come over to the X22Report.com site, scroll down a little bit, look over to your right-hand side, you'll see the video there. Or you can go to NewsSentinel.com, same thing, scroll down a little bit, look over to your right-hand side, and you can play the video right on the site. Let's get into the economic collapse financial news. Now, we've been looking at the entire economy in each sector on how each one is contracting, and we've been watching this for a very long time. And as we move forward throughout this year and as we keep going, we can see that contraction continually happens. It's not slowing down, things aren't reversing, and all of a sudden everything is getting better. And we can see that retail sales, they are continually contracting. I mean, we've been noting that there are many stores that are closing, many going into bankruptcy. And the corporate media is out there trying to convince us that online sales, that is the reason for most of what we're seeing today, is that the brick and mortar stores, well, no one's going out to shop. They're doing everything online. And we knew for a very long time this was a complete lie. So what we are seeing is that the corporate media is trying to explain away why this is happening. Now, coming out of Visual Capitalist, Jeff Desjardins, he notes back in 2000, less than 1% of retail sales came from the e-commerce sector. However, online sales, well, as we know, they have climbed each and every year since then, even though the Great Recession had occurred. Now, in 2009, e-commerce made up around 4% of total retail sales. And today, which is the latest number, it is made up of 8.3% of total retail sales. So when the corporate media is out there giving us figures like, oh, $3 billion in online sales, it's doing fantastic, it's taking over from brick and mortar, we can see that's completely fake, phony, and false once again. Now, we are seeing a huge number of bankruptcies right now. We're not even 1/3 through 2017, and we already have about as many retail bankruptcies as the previous year's total. Now, if they continue at the current pace, we could see over 50 retailers bankrupt by the end of this year. And we know with the store closing, so far we've seen around 3,000 store closing announced in 2017. And like we said before, Credit Suisse, they projected this out, and they're looking at anywhere between 7,000 to 8,600 stores being closed by the end of this year. And we can see that there's a lot of stores that are closing. And some of them Limited, Wet Seal, Eastern Outfitters, BCBG, H.H. Gregg, these are also stores that declared bankruptcy, Payless. And we can see when you go throughout the mall, you can see that these stores are completely going out of business. And what this tells us is that the American person, they do not have extra funds to go out and spend. No, they are not spending this online whatsoever because that's only 8.3% of total retail sales. What it really means, and it's not the weather, it has nothing to do with what's going on in the universe, it is because people just don't have the funds to go out shopping. And we've been saying this for a very long time. And when we look at the actual facts and the data and the actual numbers, we do have proof that this is why this is happening. So then we have to think to ourselves, if retail sales are continually declining, and we know that it's not because of online sales of why brick and mortar stores are declining, we have to think, well, is the unemployment numbers, are these real? I mean, they're telling us they're down to 4.4%. We're at full employment right now. And since everyone has a job, why aren't they going out to retail to spend this money? Well, we know, because we've been looking at all the numbers, that this is not true. But the Fed is using the unemployment numbers right now to say, yes, we are going to raise interest rates. Now, remember, we just had our GDP numbers at 0.7%. Now, most likely they're going to manipulate these GDP numbers coming up in the next round, the second quarter, to convince everyone that, yes, it is now time to raise interest rates. I think they're going to raise them before those numbers even come out. They're going to show the estimate numbers saying, oh, it's around 2%, 1%. We're at full employment. Let's raise interest rates. We already get word from John Williams, who's the San Francisco Fed president, and he stands by his outlook saying, listen, we are still going to do 3 to 4 hikes this year. We are beyond full employment right now. And the economy is operating above its potential right now. That's how great the economy is. So there is absolutely no reason why we shouldn't be raising the rates in June. Now, think about what they're saying right now. They're looking at the manipulated unemployment numbers, trying to convince us that everything is fine in this economy, even though there's a projective of 8,600 stores that are going to be closed this year. 3,500 have already closed. We're going to hit around 50 bankruptcies. And all these individuals are losing their jobs. But again, it's manipulated. They're not counted in the unemployment numbers. And we know why they're doing this, because they realize that they cannot support the system the way it is right now. Now, how do we know this? Well, 2 weeks ago, Bank of America caused a little bit of a stir, but the corporate media really didn't publish this because it really wasn't news. And what they did is they calculated that the central banks, mostly the ECB, Bank of Japan, and we know the Fed, well, they control most of this, where they're feeding them a lot of this free money. They've bought about $1 trillion of financial assets just in the first 4 months of 2017, which amounts to $3.6 trillion annualized. This is the largest central bank buying on record. What are they purchasing? They're purchasing stocks. Now, Bank of America's Michael Hartnett noted that the supersized central bank intervention, which he dubbed liquidity supernova, is the best explanation why global stocks and bonds, both annualizing double-digit gains year to date, and this really has nothing to do with Trump, Le Pen, China. It's the central banks that are propping the stock market up. Now, if we go back in time, back to October 2014, Citibank's Matt King calculated that it costs the central banks $200 billion per quarter to avoid a market crash, or as he put it, it takes around $200 billion per quarter just to keep markets from selling off. Now, the Swiss National Bank, well, they purchased a record $17 billion in U.S. equities in just the first quarter, bringing the total U.S. equity long holdings to an all-time high above $80 billion, in the process of soaking up nearly 4 million Apple shares in the first 3 months of this year. And when we look at this, we can see that on the surface, these sums appear vast. However, in the latest weekly report by Deutsche Bank credit strategist Dominic Konstam, well, he finds that something is even more troubling than what we've been talking about. $1 trillion in central bank liquidity year to date, or roughly $250 billion per month, is not enough. The reason is twofold. On one hand, there is the stock of existing central bank assets that keep growing at an exponential pace, which implies that the central banks have to monetize even more assets just to keep the system from becoming unstable or collapsing. So what does this mean for the central bank? It's either they have to up their game, which is going to be very difficult, because what's going to happen in the stock market, which we're seeing right now, is that insiders are getting out. Retail investors are coming into the market. And there's a reason for this, because the central banks realize and understand that they're pumping so much into the market right now that they can't keep this up anymore, because it won't matter. And when stocks realize just how insufficient the record $1 trillion in central bank liquidity has become, central banks, which have stepped into every single market correction over the past 7 years with some liquidity supernova, will, for the first time since the financial crisis, be out of tools completely. Something that Janet Yellen and the rest know. This is why they need to raise the interest rates. This is why they need to collapse the economy, because they understand and they realize that they brought the system to the point where they can't push it any longer. and they don't want the crash to come from a black swan type of an event. They want to cause it because they want to control the narrative. And this is what we see playing out right now. They're in the process of collapsing this system. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.